What's up, guys? All right, let's talk real estate taxes and depreciation. So, first of all, I'm not a CPA. None of my partners are CPAs. We don't intend to give anybody tax advice. But as real estate syndicators, we do need to know our stuff with respect to how the overall taxes work and depreciation works for our deals. So I'm going to give you a little bit of a sneak peek right now. First of all, when we buy an apartment building, we have basically two options of how we can take our depreciation schedule, and that's our write-off from the IRS. Number one, we can do what's called straight line. Now, straight line depreciation falls into two categories when it comes to real estate. Either residential, which is 27 and a half years, or commercial, which is 39 years. So even though we're buying commercial multifamily buildings, which is any multifamily building over 5 units, we are still in a residential category with the IRS. If we were to go buy an office building, something, I don't know what else would be considered commercial, but high-rise building, you're talking about 39 years. So anyway, what we do, and I'm going to erase this and show you guys an example real quick. So what we do, instead of that, we do what's called a cost seg, or cost segregation. And so basically what that is that's when you take the components of the building, lumber, concrete, glass, whatever it's made of, right? And you break it into all these different categories that the IRS allows you to do. And the real summary, or sort of the big picture of that, is the IRS says, well, hey, wood lasts longer than, glass, and glass lasts longer than steel, or whatever the case may be. And so they let you break things, if you really want to, into categories and depreciate them differently. So when we order a cost segregation report, we're able to accelerate the depreciation because we're putting these things in these different buckets. There's also something called bonus depreciation. And that was basically something that came up as part of the 2017 Jobs Act. They put a situation in place where you could do bonus depreciation, where the first year that you bought a building, you could actually take 100% of the depreciation. Now, since then, it's starting to kind of wean back a little bit. So this year it's 80%. Next year it goes to 60%. But it's still a huge, huge benefit, right? So I'll give you just a real life example of how this actually works out for the property and how it can work out for an investor. So let's say that we buy a $3 million property, right? Now, you're not allowed to do depreciation on land, only on improvements. So if we buy a $3 million property, and let's say that it's consisting of $2,650,000 of structure or building, and $350,000 of land, right? Sort of arbitrary, but makes sense in the areas we buy. But that $2,650,000, that's effectively what you can write off when it comes to your depreciation. So what I'm going to do, you guys are following here, stay with me. We bought a building for $3 million, but we have $2,650,000 of actual structure that we can now write off. So if we go 27 and a half years, which is straight line depreciation, the IRS is basically saying, grab my calculator here, $2,650,000 divided by 27 and a half years, boom, $96,000. So the IRS is saying, okay, bought that property for $3 million, we can take a $96,000 write-off every year. 96,000, 96, 96, 96. So if you're an investor in that deal, and let's say you own 10% of the deal, you would get a negative K1, or a write-off, for $9,600. Now, it's a little more complicated than that because the depreciation is one item, right? When you do your taxes, you have to look at, okay, how much rental income did you have? What were your expenses? How much did you pay for your interest on your loan? And then also, what was the depreciation? But let's just assume in a perfect world here, we're just talking about the depreciation. So if we show a $96,000 loss at the property level, you as an investor would get a negative K1 for $9,600 that you and your CPA could potentially offset against other gains, whether that's passive or active income that you would have on your side. So, but let me show you how that changes. 9,600, remember that number. 9,600, instead, on this same deal, 2,650,000, through doing a cost seg and a bonus depreciation, we're actually able to get a write-off of closer to $750,000 in the first year. It's huge. And what that does is, if you have a 10% stake in the deal, all of a sudden, your K1 is for $75,000, or negative $75,000. So now you've gone from getting a tax benefit of a negative K1 of $9,600 to actually $75,000, which is what? 75,000 minus 10, $65,400 in additional tax benefit that you wouldn't have otherwise had. So again, we're not CPAs. We're not saying what you'll be able to use or not use on your taxes. But the big takeaway, if you have one, is this. Let me draw our building. So our job as the syndicators or the people managing the deal, our job is to take this building that is making money, but show a big loss on paper, thanks to the IRS and cost segregation and bonus depreciation, show a loss and issue that loss as all these little small fractionalized K1s to all of our investors that are part of the deal, give them back to everybody, and let everybody use them the way they can. So anyway, hopefully that gives you kind of a general idea of what we do. This is one of the reasons we love commercial real estate. We love depreciation, and it's much different than when you buy a house and you take straight lines. So anyway, thanks.